founder with the Saigal Capital, or founder of Saigal Capital actually, not with. It's a new company, right?
That's right, Nikun Bhai. Uh, as
Congratulations.
you're aware, thank you. Thank you very much. Um,
So what
as
is
you're aware,
Anshul Saigal buying in Anshul in Saigal Capital? Let's talk about it.
so Nikun Bhai, very interesting question. And as you are aware, you and I get thrills out of finding mispriced bets in the markets. And the fact that markets realize what you realize today, tomorrow, that gives you a great thrill. Of course, you make the money in the process, but it is about the intellectual satisfaction as much as about making the money. In that context, times like the first quarter of this year, where markets were really on a risk-off trade, and across the board, gade gode, koi nahi dekhe, everything was sold. That affords tremendous opportunity for people like us who look for mispriced bets. And that combined with what is happening in the US, where you have so much of uncertainty because of the tariff situation, it has given rise to tremendous opportunity in the markets. When we speak to companies and we analyze companies across the board, we see multiple companies where, and these are quality companies, by the way, not run of the mill companies, where earnings growth in the next 2 to 3 years could be as much as two times from current levels. And that is on the back of revenue growth, not just because margins are expanding. And when those companies see correction in prices, clearly there is a disparity in underlying growth and fundamentals and the value that markets are ascribing to these companies. That offers us opportunity. We are finding that situation in multiple sectors, metals, trading companies in pharma, metals, even retail companies, value retail companies. We are finding such opportunity in financials, and across the board, even capital goods, we find opportunity. So we have been in the first quarter of this year buyers and consolidators of our positions. So that's where we are at this time.
Hi, morning. That's one part of the story. The other one, of course, is what is it that you stay away from and avoid in this market?
Aisha, earlier this month, I was, good morning, Aisha. A pleasure to be speaking with you. Earlier this month, I was in the US at Omaha, actually, for the Berkshire meeting. And what came about in that meeting was twofold. One is that that never write off US. Of course, that was Mr. Buffett's view. But across the board, when I spoke with fund managers, that was the view that was coming out. But within US, the view was that you have to bet on the real economy, that manufacturing, that cyclical sectors, metals, etc. Those are the spaces which are likely to do very well. And so, if you look at the other segment, which is the Mag 7, the tech space, which has done exceptionally well over the last, say, 20 years, it looks like that is a space which will consolidate going forward, as also the tech space in general, IT services also. Now, if that is the trade that is likely to play out in the US, then we will see a similar trade play out in India with added uncertainty of AI actually subduing the growth potential of many of the tech companies going forward. Also, bear in mind, post-COVID, these companies sought significant tailwinds in demand and growth, of course. Multiples expanded. What used to trade at 15 to 20 times price to earnings started trading at 25 to 30 times. And for growth, which is between 0 and 5%, that's not very lucrative in our judgment. In a country where growth is significant on the ground for local companies. So this is a space that I would be cautious on. And within this space, of course, there will be that odd individual opportunity which will make money. But by and large, this is a space that we would want to stay away from.
Spoke about few stocks, and I'm just going to jog my memory. Tick, 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 tick. Okay, got the names. Global Spirits, and the next was coincidence. The next tip was actually tips, right?
You are right. I mean, we did speak about those companies as case studies.
Okay, let's discuss those two case studies. Alcohol, beverage. It's an interesting space. It's a space where everybody was excited 2-3 years ago, but somehow very few stocks have made money. And it's a space where I think almost a dozen companies are listed now. What is the best way to approach alcohol beverages or alcohol bev space, and which are the good case studies there?
Nikunj bhai, this is a very interesting space. We are only, I mean, if my memory serves me right, the per capita consumption in India of alcohol is somewhere in the region of 3 to 5 liters, or maybe 10 liters, under 10 liters. And that compares to China, which is around 45 liters. So there is a significant disparity in consumption patterns, and that's largely because of our per capita income itself being under $3,000, while China's being around $12,000. And then let's not even talk about the US, which is over $60,000. Now, as our per capita income rises, clearly consumption patterns in this country will see a sea change. And say in the next 3 to 5 years, we could well see the market itself doubling. Now, if the market doubles and you've identified a quality business in this space, clearly that business can beat market levels. So room for growth in this space is substantial. And what we are seeing is that a lot of companies are building quality homegrown brands. And the market is actually veering towards consumption of homegrown brands. That is a phenomenal sort of setup for this sector to do very well. The company that you spoke about, and we spoke about as a case study, that is very interesting dynamics. It has two segments. One is the ethanol space, and the other is the alcohol beverages space. In the alcohol beverages space, that company trades at somewhere, or it has a ROC of somewhere close to 80 to 100%. And I mean, I say that with understanding of the numbers. And on the other hand, the ethanol business that has a sort of ROC of around 15 to 20%. Now, this company trades at a fraction of the alcohol beverages pocket. That whole space trades at somewhere close to 10 times revenues, while this company trades at a fraction of that. Our judgment is that as the market realizes the true potential of the beverages business in this company, there is likelihood that it will get re-rated. Even if that doesn't happen, downside is not there because most of the downside is in the price. So it is a very favorable risk-reward opportunity or case study at this moment. That's how we look at this particular opportunity. And there are a few others in the market where we see similar sort of dynamics. Um, on the other name, they announced their recent results and they reiterated their guidance, where they said that 30% revenue and profitability growth is what they anticipate in the music business. Now, if that is the case, and the company trades at current valuations, which are somewhere close to 30 times price to earnings, for a company that does 350% ROIC, this looks like a very reasonable valuation. For these growth dynamics, companies with such ROIC profiles can go up to 80 to 100 times price to earnings at some point in their journey. That is what we are sort of anticipating in a name like this, and which is why we spoke about this company last we spoke.
Okay.
Right.
Mahindra and Mahindra. Now, Anshul bhai, this entire impact of early monsoon, I mean, if monsoons are late, it's a problem. If monsoons are early, that's also not great. Do you think we should stop getting excited about the fact that monsoons have come early? Because ultimately it's a weather pattern which has changed and it will have impact on vegetable prices, food prices, crop sowing, and this is May. I mean, the June and July bacha hai abhi.
First of all, Nikunjai, power demand has come down, but samosa demand has gone up. So, if we can find samosa stocks, perfect. As an aside, of course. But power and also rains. We've been in the markets long enough to see that seasonality and these small um, events, while they are good talking points in that year, and that they are issues in the short term. But if we look beyond that short-term period, 2 or 3 month period, then really it is the fundamentals of the markets which take over. um, Good monsoons is by and large good for the country. And of course, there will be that odd issue or in one sector or the other in while monsoons are ahead of time. But by and large, it should be good for the country. And this year should be no different. If earnings growth continue in the same trend as the markets expect, which is that between FY25 and FY27, Nifty expectations are likely to be in the range of 12 to 13% CAGR earnings growth. If that continues, this market will have support. And we also need to bear in mind that this market, of course, valuations are one aspect, but ownership of the market is the other aspect. Ownership towards the last quarter of last year had gone up meaningfully. Markets were heavy. In the first quarter of this year, ownership has come down and markets are relatively light. And so, valuations being reasonable, markets being relatively light, this is a good combination for markets to give reasonable returns going forward. That is what we anticipate from the current sort of setup.
Well, Alshun, definitely not samosa stocks, but yeah, stocks like Zomato and Swiggy, which do deliver samosas to us in rains, they're definitely part of the listed pool. But tell me, how are you stacking up both Zomato as well as Swiggy, and especially Zomato, given that the stock is, as of yesterday, already knocked off about 25 to 26 odd percent from its 52-week peak, and now the weight reduction in, FTSE as well as MSCI definitely weighing heavy on it.
Right. Aisha, actually, in our investment style, we tend to not really chase stocks, particularly if these stocks are expensive in valuations, and secondly, if they're not making much money. Now, despite this 26% kind of decline in the stock price, if you look at the market cap of the company, I forget what the last number was, but my guess is somewhere close to 2 lakh crores. That is not, a very sort of small market cap which can give you tremendous upsides from current levels in our judgment. And also the road to profitability is not very clear. There is, of course, that move which the company has indicated towards profitability, and they have shown some progress on that. But whether that profitability justifies this sort of a market cap, we are not very sure. So, for us as an absolute return investor, we are not very excited by the current level of the company, as also the market cap size. And we find tremendous opportunity in the broader markets, in that range of 5, 6,000, 10,000, 20,000 crore market cap companies, which we anticipate can give very healthy returns, can double over a 3 year period, and hence that will pique our interest more. And so that's just the sort of makeup of our investment style, which is why we are not very excited by this space at the moment.
Should also help us with your take on the pharma pack as well, because off late the stock and rather the sector is seen to be consolidating a bit. CDMO as a space is the only outlier there. Help us understand that how are you looking at the numbers so far and what are the key triggers that you're watching out for?
Hi, Srishti. Yes, you're right. This is a space which has consolidated in recent times. And we are also actually quite positive on the CDMO space, much more than we are on the generic pharma companies. The reason being that India is currently at a 3 to 4% market share of a market which is 150 to $200 billion, mostly catered to by countries outside of India, particularly China. I think is about 50 to 60% market share in this space. And our judgment is that even if a small portion of that China plus one anticipated move happens towards India, say 3 to 4 billion move from China, which is clearly 50% of the market at this moment. Um, we will be doubling our markets just by virtue of that small move away from China. And if that happens, this space will have tremendous tailwinds. And our belief is that India, amongst various sectors, India has tremendous chemistry capability as also manpower available to take advantage of this opportunity. And we are likely to do that in the years ahead, in the next 3 to 5 years. So CDMO looks very interesting for us. As regards generics pharma, we think that there is some uncertainty because of the tariff situation, as also the pharma headwinds in the US. We think that as a result, there will be limited upside to multiples in this space, and one would need to be slightly cautious on generic pharma, particularly exporters to the US. Domestic pharma has very nice dynamics, almost FMCG sort of dynamics, and that space could see tremendous interest. So we think that domestic pharma and CDMO, those are the pockets of opportunity at this moment.
Anshul, what's the best way to capture on this entire, travel and tourism boom? And would you say Interglobe at even 5,400 thereabouts is still a buy?
Um, this is a great company, Aisha, and clearly it is. In recent times, I saw that they have now about 60% market share in the country's aviation space, which just tells you how dominant a player this company is. And through cycles, one has seen that they've remained profitable in an industry where profitability has always been in question. Again, that tells you how strong their delivery platform is. And India is only scraping the surface as regards where the market will be in the next few years. If my memory serves me right, again, we are at about 400 odd planes for the entire country, and that number is likely to go to 1,000 in the next 3 to 4 years. So clearly there is tremendous growth which is likely to happen, and this company will in all likelihood remain the front runner in the space. So definitely a company which, if someone wants to play this sector, one should really look at. Aside from this, this space, in our judgment, is going to really take off for the country as a whole. There is an all of government effort to make sure that we see tourism grow in the country, and also private sector is really rising to the occasion today. They also have deep pockets as a result of recent times where they made tons of money, and balance sheets are far better than they used to be in previous cycles. As a result, companies like the hotel companies, to some extent, even the QSR companies which play into this space, um, all of those pockets will see tremendous interest as we move ahead. So this is an interesting space, no doubt, and this has legs for the long term. And if you can identify right pockets in this space, there will be tremendous risk-adjusted returns to be made.
Would you like to help us with your take on this particular counter? Because in the listed space, and especially when it comes to some of those key players within the bottle industry, this is one of the key players right there holding a good market share as well. But give us some sense that how do you see the valuation and the growth prospects for this particular counter?
Srishti, I'd prefer not to talk about the individual company because I'm not an expert on the sector. Neither do I have a very strong hang on valuations. But be that as it may, on the space as a whole, it's quite evident that India is again at a takeoff stage for this space. That is beverages in general. And you know, we have a new player come in, which will have some uncertainty into the sector for existing players. But clearly, the space has enough room for new players to come in and also participate in this growing trend. In that context, if there is any uncertainty led valuation correction, that should be seen as only a blip in a long-term trend of an upcycle in the space. And investors should really focus on the long-term trend of uptick in the demand in this space to take calls on individual companies.
Right. Anshul bhai, just closing comments. We are talking about big consumption boom, but with the exception of trend, none of the so-called retail companies or fashion retail companies in India have really managed to make it big. For the longest time, ABFRL has struggled to create wealth. Arvind has not been a great money spinner. Raymond's has become a special situation stock, but otherwise not too many winners here.
That is right, Nikunj bhai. In fact, this is not a very easy sector to navigate for the reason that it isn't just about the profitability. This is a sector where cash flows matter much more than profitability because you have inventory sitting which can go out of fashion in a minute actually. And for that reason, only those companies which have been able to navigate the working capital cycle well and then remain profitable over cycles, those companies have done much better than the rest. Trent, for one, has navigated that balance very well. There are a few other companies also which have done that reasonably well. In fact, some companies have been willing to let go of growth when working capital cycles have been strained. And that is a very good sign in our judgment that these companies over cycles will do very well. We believe that where we stand today, value retail looks very interesting. And some companies in value retail have managed the balance between profitability, growth, and working capital management reasonably well. They have shown an uptick in stock price in recent times, as also in their business tailwinds. And our judgment is that as the industry picks up, as same-store sales growth picks up, which is clearly, and we are seeing that on the ground, we think that this space could get re-rated. So value retail is very interesting, and you could see some big winners in this space going forward, which will give you some succor because one will get companies outside of trend which will have done well.
All right, Anshul, with this, we let you go on that. Thank you so much for taking the time out and speaking with us this morning. Always a pleasure.
Thanks, Srishti. Thank you.
If you like this video, then like, share and subscribe to ET Now.